Today's highlights. The Federal Reserve suddenly changes its stance. Rate cut expectations are at their peak. After Bitcoin's surge, can it still hit $90,000? Bitcoin loses a key level. Can ETF inflows provide support? JPMorgan makes a surprising move by accepting Bitcoin as collateral, but this triggers resistance from crypto holders due to new MSCI regulations. November 24th. This is BitcoinTV Chinese channel. B Union is here. I'm Dong Dong. Let's first look at the past 24 hours in the crypto world. For today's data headlines, around 9:30 this morning, the cryptocurrency market basically recovered from the weekend dip. The total market cap has reclaimed the $3 trillion mark, now standing at $3.03 trillion, up 0.7% in the past 24 hours. Bitcoin surged past $88,000 this morning and is now hovering around $86,818, rebounding 7.7% from last Friday's low of $80,600. Ethereum has returned to $2,800, and BNB is back above $840. Solana also surged past $130. More importantly, the CME FedWatch tool suddenly shifted, with the probability of a 25 basis point rate cut in December soaring from less than 40% to 67.3%, while the probability of holding rates steady dropped to 32.7%. With the shift in policy expectations, plus Barclays coming out to say that a rate cut in December now seems more likely, market risk sentiment immediately warmed up. Bitcoin rebounded directly from $80,000 all the way to around $87,500. However, on the macro level, things are still unstable, and in the short term, it's highly likely to remain stuck in the $90,000 to $100,000 range. Next, the market is just waiting for direction from the Fed's post-blackout period and the latest economic data. If you want to know how the market will move this week, click the little bell. Join the MSCI membership to watch our exclusive weekly review for members, released this morning at 8 o'clock. Recently, on-chain data has revealed a major event. The open interest in the Bitcoin market has plunged as if it were on a free-fall ride, marking the largest drop in the past 30 days. Just on Binance alone, the reduction in open interest is equivalent to 1.3 million Bitcoins, making it the main force behind this round of deleveraging. The last time we saw a plunge like this was in the bear market of 2022. In October, the market kept falling, and forced liquidations became more frequent. Those who went against the trend and used leverage had their positions wiped out, leaving only the remaining traders. Seeing that the situation was turning bad, the remaining traders also started to give in and reduce their positions, which in turn intensified the liquidation storm in the market. Looking at it from a cyclical perspective, a major shakeout of this magnitude usually only happens at 2 points in time, either when speculation at the peak of a bull market gets crushed or during the major reshuffling before a new bull market begins. As for this round of price increases, it was actually propped up by the highest level of futures leverage in history, making the structure extremely fragile. So, once market liquidity tightens, or everyone's risk appetite drops, it becomes especially easy to trigger sharp corrections like the one we're seeing now. Simply put, the collapse of open interest this time doesn't mean that Bitcoin's fundamentals have fallen apart. It's more about the whole system deleveraging and squeezing out bubbles. And from historical experience, this kind of painful phase is often when the bottom is forged for the next bull market. After the Coinbase Premium Index dropped for 10 consecutive days, it finally seems to be catching its breath a bit. However, it's still hovering around a slight negative premium of about negative 0.02, which means institutional buying hasn't really kicked in yet. According to historical patterns, as long as this index can steadily climb back above zero and hold there for a few days, it indicates that institutions are quietly accumulating again, and market sentiment will gradually shift from fear of a crash back to the confidence to buy. At the moment, this rebound looks more like an automatic correction after being oversold. Whether the trend has truly reversed still needs a few more days to observe. If, in the future, it can regain the fair value level, that would be the first clear signal that Bitcoin is entering a rebound structure. Please like and follow for updates as I break down the latest developments in the crypto, blockchain, and mining circles within the past 24 hours. Click the little bell to join the channel and become a member, and receive the members-only wealth codes for Bitcoin from Monday to Friday. This recent move in Bitcoin really feels a bit shaky. It broke below 6 figures directly, causing everyone's confidence to flash red. Once the key technical levels and on-chain structures are breached, I can only lower the probability of a short-term rally to below 50%. Of course, as long as those key levels can be reclaimed, the story could instantly reverse again. But for now, the market has indeed shifted from a strong upward push to a straightforward correction. Although this drop is quite severe, buying the dip before a confirmed bull market may not be a good idea. In a bearish trend, so-called pullbacks often turn into even bigger traps. short-term rebounds are often followed by further declines. This is very common during a downward cycle. So right now, it's more important to let the data speak for itself and not rush to call the bottom.
Data shows that last Friday, US Bitcoin ETFs saw a net inflow of billions in funds, despite BlackRock experiencing a net outflow of $122 million. All other ETFs showed net inflows, successfully filling the gap. This resulted in a total net inflow of $238 million.
And the difference this year is the participation from listed corporations, so MicroStrategy and its copycats, who are really driving the equity capital markets right now, are wide open for crypto strategies, and that's been the hottest part of the market.
In addition, the MVRV ratio and Bitcoin's realized price provide a clear picture. They show the broader market's cost basis. Currently, the network's realized cost basis is concentrated in the $50,000 range, and the daily upward trending 200-week moving average is also following the same trend, likewise situated in the $50,000 range. Historically, when the price meets this average, it often presents a strong long-term accumulation opportunity.
As soon as Bitcoin dropped below several key levels, the market immediately shifted from charging ahead to holding steady. Don't worry, the long-term fundamentals haven't changed, but in the short term, this price action really doesn't look like a healthy bull market. A more reliable approach right now is not to blindly buy the dip, but to wait until the market clearly moves in one direction before going in heavy. Pay attention to the macro picture and don't force it. Only increase your position when there are truly strong signals. After all, no one can perfectly time the top or bottom. What you really need to do is position yourself in areas with higher probability of success and base your decisions on confirmed market structures, instead of trying to guess the bottom or bet on a direction. JPMorgan Chase CEO Jamie Dimon used to be Bitcoin's #1 critic, constantly calling it a scam and never holding back when it came to criticizing the hype around it. And what happened in the end? Now that the tide has turned, this bank has done a complete 180. They're actually preparing to treat Bitcoin as collateral, just like stocks and gold. As for Dimon himself, even though he still says he's not optimistic about it, his attitude has clearly softened. His favorite saying now is, "I don't smoke, but I defend your right to smoke." The meaning is simple. Even if I don't touch it, if clients want to play, I have to serve them well. To put it bluntly, JPMorgan's actions speak louder than its words. But recently, the movement to boycott JPMorgan in the market has been gaining more and more momentum. The plot has really taken a dramatic turn.
Well-known real estate investor and Bitcoin advocate Grant Cardone publicly announced that he has transferred $20 million out of JPMorgan Chase and has filed a lawsuit against the bank for violations related to its credit card business. At the same time, Bitcoin opinion leader Max Keiser has called on the market to take down JPMorgan and to fight back by increasing holdings in assets like MicroStrategy and Bitcoin. Analysts have pointed out that if MSCI ultimately implements the relevant adjustments, it could lead to passive divestment by institutions, putting short-term pressure on related individual securities and the digital asset market.
So how did this all start? It's actually quite dramatic. The world-renowned MSCI announced that starting in 2026, it will remove all companies whose balance sheets contain more than half in cryptocurrencies from its major indexes. And as it happens, this news was first leaked by a research report from JPMorgan. This immediately set off an uproar in the Bitcoin community. People felt that JPMorgan was trying to trip them up behind the scenes. So that very night, there was a call to boycott and divest from JPMorgan, increase Bitcoin holdings, and vote with their feet. In short, the data company wanted to clean up its image, the bank became the messenger, and Bitcoiners felt singled out, so they decided to strike back. This whole online movement really took off. No matter how you look at it, it's a lively scene.
Here there are legends of overnight riches, as well as carefully orchestrated scams. This is a chaotic and lawless dark forest, but it also nurtures the hope of a brighter future. The destination of faith is freedom, and the end point of consensus is equality. BitcoinTV, guiding you through the fog, seeing the future, and getting rich together, step by step.
Crypto ATMs in the US and dispensers during the crypto winter discuss money laundering and company sales. A stablecoin used by 500 million people is integrated into consumer scenarios by Visa, and AI payments may be the next big thing. The FBI's data is truly alarming. In 2024, there have been nearly 11,000 scam complaints related to crypto ATMs, with losses exceeding $264 million. Because these machines offer strong anonymity, they've become standard equipment for scammers, forcing states to tighten regulations despite their reluctance. In Stillwater, Minnesota, several residents lost thousands of dollars, and some even fell for fake PayPal overpayment scams. Locally, they simply imposed a blanket ban on all crypto ATMs. Spokane, Washington also followed up with a ban in June, and in places that haven't outright banned them, they're starting to impose transaction limits. You could say that crypto ATMs in the US are now under heavy fire, and by 2025, the industry will be facing a full-blown regulatory winter. Yet right at this critical moment, Chicago's crypto dispensers has stirred up another wave.
Crypto dispensers suddenly dropped a bombshell. The CEO is under federal investigation for alleged money laundering, and the company has now announced it is seeking to sell for $100 million. The announcement of the sale came just days after the U.S. Department of Justice filed charges. Prosecutors allege that since 2018, company owner Firas Issa has used the ATM network to launder at least $10 million in funds from telecom scams and drug trafficking.
Somehow I was eventually persuaded, after some hesitation, to actually go to the bank and withdraw some money from my line of credit.
Janice walked out of the bank with $18,000 in cash. Her next stop, a Bitcoin ATM.
I felt almost as if I had been hypnotized. It's more than devastating. For a long time, I couldn't stop blaming myself.
Issa and the company have both denied the allegations, but if convicted, he could face up to 20 years in prison. The company's related assets may also be subject to seizure. Notably, the company's announcement did not mention any lawsuits. It only emphasized that since 2020, it has ceased its physical ATM operations and shifted to software, citing too many scams and excessive regulation as the reasons.
Issa talked up the company, claiming that developing hardware had no future, but everyone in the industry knows the real story. It's just that under tighter regulation, they didn't dare to keep playing the game. The new regulations in the US are getting tougher and tougher. ATMs now need fingerprint and facial recognition, and any transaction over $3,000 has to be reported immediately. Upgrading a single machine to meet compliance costs over $20,000. For small companies, even survival has become a problem. From people in the Spoken community calling crypto ATM scam machines to the federal government directly investigating money laundering, the days when you could quickly make money in this industry with just 100 machines are truly over. With regulations this strict now, and the CEO still facing lawsuits, anyone daring to take over crypto dispenser for $100 million must be a bit reckless. Visa's Vice President, Qui Sheffield, has recently exposed everything about stablecoins. It turns out these things are no longer just speculative toys for crypto insiders to hype themselves up with, but have actually gained traction thanks to real needs like holding US dollars and cross-border money transfers. What's even more impressive is Visa's move to link stablecoins with bank cards, which basically brings digital assets right into everyday life. You can use them to buy bubble tea or pay your rent. In places like Argentina and Nigeria, where saving US dollars is nearly impossible, stablecoins have essentially become portable little dollar vaults. No wonder 500 million people are using USDT. But as convenient as these tools are, they do have their quirks, and there are indeed quite a few bugs when it comes to using stablecoins.
The more users spend, the more money payment companies lose, because once funds are transferred, they can't earn merchant fees. This creates a profitability dilemma for stablecoin payments. Chai Sheffield at Visa proposes linking stablecoins with bank cards, letting stablecoin accounts connect to the Visa network. Users keep on-chain assets and can spend at 15 million merchants, while wallets and issuing banks earn merchant fees. This revives the profitability model.
It starts with Visa Direct. So Visa Direct is our cross-border, real-time money movement platform today. For example, if you wanted to send money to someone, you could load your bank card into it. You could also use your bank account. But now we're adding stablecoin wallets as a way to receive money.
The two main growth engines for stablecoins are cross-border payments and on-chain lending. Cross-border payments primarily use a fiat stablecoin fiat process, and Visa is now opening its cross-border real-time network, Visa Direct, to stablecoins to improve efficiency. Meanwhile, on-chain lending has fully entered the practical stage, with the total volume of stablecoin loans exceeding $670 billion to date.
The current divide in the banking world is really dramatic. In the US, banks are so bogged down by regulations that they don't dare to make a move, while banks in Brazil and the Philippines are already charging ahead because all the young people have switched to stablecoin wallets. If they don't get on board soon, they'll lose all their customers. Kouchoufield put it very bluntly. In the future, there will definitely be a dual-track system of global dollar stablecoins alongside local currency stablecoins. Whoever has more relaxed regulations will be better able to retain users. This race simply can't wait for anyone. What's even more interesting is that the next stop for stablecoins might be to directly enter the world of AI agent payments. In the future, when your AI checks the weather, it will automatically transfer a few cents to the weather AI. These kinds of micropayments between AIs will become routine. Stablecoins are especially well suited for small value transfers. It's practically the dedicated wallet for the machine economy. Visa has already started paving the way in advance. What kind of big show will unfold next is hard to predict, but one thing's for sure, it definitely won't be boring.
On November the 24th, when US President Trump took office at the beginning of the year, he made a big move by establishing a special government efficiency office called DOGE to slim down the size of the government. But before this department could even finish its term, there were still 8 months left. It dissolved itself first. It's a textbook example of a team breaking up not long after starting work. Overseas, QOL announced that the video platform Rambo, which is backed by Tether, has quietly put its tipping feature on the blockchain. Now Bitcoin, XAU, and USDT can all be used directly. However, it's still in a small-scale internal test, only open to a few thousand lucky Android users, so it's more like a quiet trial run. Cointelegraph cited the latest data from Atmos, asking, who received the most stablecoin inflows in the past 24 hours? The answer is C. They directly attracted $2.4 billion, leaving Aptos and Ethereum far behind. It seems that this wave of stablecoin funds is lining up across multiple chains to switch tracks. Today, Ethereum founder Vitalik Buterin posted that accounts will now display their country of origin. The meaning of this new feature is quite straightforward, and in the short term, it should do more good than harm, bringing a lot of positive effects. US Treasury Secretary Janet Yellen bluntly stated that this government shutdown is no joke. It directly slashed $11 billion from the US GDP, and that's a permanent loss. Once the money is gone, it's really gone for good.
In life, the hardest lesson to learn is to reserve your kindness and gentleness for those who truly cherish it. It's not that you're too generous, but that your heart is too soft. It's not that you give too much, but that you can't bear to say no. Unfortunately, some people aren't unaware of your goodness. They're just used to endlessly taking advantage of it. You reach out to them again and again, and they respond with indifference every time. You consider their feelings, but they never truly care about you, until one day you finally understand. People who don't know how to cherish you are simply draining your life. But those who are truly worth it will value your feelings, not treat you as an emotional dumping ground who is always at their beck and call. From now on, put yourself first. Set boundaries for your kindness and make your efforts dignified. Remember, your goodness is precious. Only those who know how to cherish will understand this. If you do, please give us a like. Alright, that's all for today's main content. Our channel focuses on valuable news summaries from the crypto, blockchain, and mining circles. We provide both news updates and in-depth special reports. If you find our channel valuable, feel free to share and follow us. You can also become a member and receive our exclusive wealth codes from Monday to Friday. Let's get richer together and add another zero to your assets in the bull market. See you tomorrow.